So today we're going to talk about agriculture funding, and this is a very hot issue in Africa because of a lot of the losses that people encountered during the AgriTech craze. So we're going to delve into some of those mistakes, what I think about agriculture, AgriTech funding, which is a merger of agriculture funding and technology distribution platforms. So the first thing to note is that crowdfunding or AgriTech is really project finance at its heart. So you're essentially lending money through a middleman that is a technology distribution company, a company that has an app and is helping to distribute that funding to small-scale farmers or agriculture cooperatives or whatever it is. But essentially, you're having to go through a technology platform or a middleman, and you're lending money towards a particular productive activity. So it's really project finance. So you need to understand the type of investment you're doing. You're lending money. It's debt. It's not equity. You don't have any shares in the business. So literally you're just lending money for a particular activity. So it's pure play debt with all the risks that comes with. So it's high risk and it's largely unregulated because in Africa we don't have a lot of regulation around crowdfunding, around agri-tech. Some of the regulation has a high barrier to entry. So even those that can, go through the regulated pathways, a lot of times it's only the big asset managers that can afford the fees and the structure that is required for regulated crowdfunding. So it's a lot of the smaller companies doing agri-tech are doing it under the radar. They are unregulated. There's no authority that they report to or that you can appeal to if there's a default. So it's really a high risk form of debt or project finance that is unregulated. So that's why when there was the whole bust in the agri-tech sector, a lot of people were burnt and they could not recover their monies because it was really just very unstructured debt, a lot of times without contracts. The terms and conditions were on the website and you just, check a box or click a button to accept the terms and conditions. Many people didn't read those terms and conditions and they had no contract. So really, what are you going to do in the event that you're burnt? Ideally, project finance should be for institutional or accredited investors because retail investors don't have the structure. You probably don't have a lawyer that draws up your agreement or reviews your agreement. You don't have the structure for due diligence. So just imagine when the banks lend money to a business, look at all the hoops they put you through. So if you've ever had to borrow money from a bank, look at all the documents that you're asked for, the collateral. That is project finance. Now, a retail investor doesn't have that structure. So ideally, retail investors should never have gotten into crowdfunding. And yes, there was a lot of buzz around it. I mean, I was a victim. I also invested in some agri-tech companies, but with the benefit of hindsight, retail investors have no business, investing in crowdfunding or agri-tech because you don't have the structure to really do a lot of due diligence around those deals. You're at the mercy of a middleman. So remember, the way agri-tech works is you're going through a technology platform or an app, and what the app does is that it aggregates funding from retail investors to lend to farms at the other end. So essentially, you are at the mercy of that technology middleman who may or may not understand anything about agriculture to begin with. So a lot of the numbers are usually very fantastic. A lot of the returns on investment are typically fantastic as well. And that's because the metrics of technology are completely different from the metrics of agriculture. And then finally, the insurance is in the name of a third party. It's not in your name because the platform aggregates. So a lot of times insurance companies would only cover actual production. So you might find that the insurance is in the name of the farm or the agriculture company. It's not in your name. So you're taking all the risk and you have none of the insurance in your name. Insurance also doesn't cover bad management. So if that agriculture activity is badly managed or the tech platform badly manages the remittances, distributions of the dividends, there's nothing that insurance can do, in that case. Project finance is highly specialized. Again, going back to the banks, when the banks want to lend money to a company, there's a lot of due diligence that goes into it. You have to submit documents to prove that you're a registered, going concern. Sometimes the founders of the company need to give personal guarantees. The banks go to visit, the premises of the company. There's a lot that goes into, debt financing or project finance. So it's actually quite extensive in terms of due diligence. And the release of funds are typically tied to KPIs. So the lending institution would have a set of KPIs that the lender must meet, and the funds are usually released in tranches. So it's not, a case of, someone comes, to borrow money and they give, 100% of the funds. And then physical inspections are typically mandatory. So whatever activity you're lending money for, typically the bank or the lender would inspect. So there's that physical going, to the premises where that activity is taking place. So you see why it was a bit conflicting when retail investors began to invest in agriculture finance, because a lot of the retail investors never bothered to go, inspect some of the farms. They never bothered to go inspect some of the technology companies that were middlemen. And this is not to disparage the retail investors. A lot of it was just, blind trust, and sometimes just really, thinking the best, of these new and innovative platforms. So a lot of times retail investors, you may not be able to, go inspect a farm yourself, and you're trusting that the middleman, which is the technology platform, should have done that due diligence for you. And then finally, in any sort of project finance, you will typically have a special purpose vehicle known as an SPV that houses the collateral or some sort of security until that project is complete. So that kind of serves as a buffer and gives you a bit of peace of mind that even if something goes wrong with the project, you have some underlying asset or intellectual property that belongs to you as the lender. And then you would have an escrow account where revenues from the project finance activity go into that escrow account. It cannot be spent by the lender. So typically you would have whoever it is that actually lends the money would have control, or at least signing authority or view only access to the escrow account. So whoever borrows the money can't just spend the revenues anyhow until they finished paying the debt. So that's another level of security. And then finally, the lender can appoint, the CFO. So you see this a lot in private equity, where you give a huge sum of money to an organization, and you insist on appointing the chief financial officer until that deal is done. And that's because the chief financial officer sees the actual finances of the company. So the company, can't just, cook books. The borrower can't just, cook books, because you have appointed your own CFO in that sort of situation. Another way to kind of invest in agriculture is through cooperatives. So if you're a member of a cooperative, like my cooperative, the cooperative reduces the cost of due diligence. So the cooperative can hire a lawyer, can hire a forensic accountant, can really do the due diligence that needs doing before you invest. And the cooperative can also subsidize the cost of the physical inspections, the management of that deal. And even if anything goes wrong, so in our cooperative, we were victims of some of these AgriTech companies. Well, we were able to make recoveries simply because as a group, we were able to engage, regulatory agencies and law enforcement agencies to get justice. So when you belong to a cooperative, you're not on your own because, you have an institution of hundreds of thousands of people behind you, which is better than if you invest on your own. Now, finally, with food commodities, this is a way to still invest in agriculture, but do it in a regulated manner. So there are commodities exchanges, particularly in Africa, that are regulated, that aggregate food commodities on a technology platform. So you can actually buy and sell those food commodities, but you need trading skills. So there is a measure of risk in the sense that you need to know when to buy and when to sell. But in terms of regulatory risk, that has been minimized because these platforms are typically regulated by the Securities and Exchange Commission. Now, because sub-Saharan Africa has predictable seasons, we have a wet season, we have a dry season. That means there's also a predictable demand and supply cycle. So take maize, for example. You can actually buy on a commodities exchange during the dry season. The commodities exchange has a storage system that is already embedded on that technology platform and is provided through the technology platform. So you can buy and stockpile during the dry season and then sell during the wet season when it's time for planting. So a lot of times, for those who are interested in participating in agriculture, you can do this in a regulated environment through a commodities exchange. Nigeria has a commodities exchange. Kenya has a commodities exchange. So this is a good way to participate in agriculture funding, agriculture investment, but through a regulated platform. Some of these, exchanges, for those who don't have trading skills, they actually have principal guaranteed commercial papers. So what the commodities exchange does is recognizing that some people may not want to trade on their platform. What they've done is to provide a product in the form of a commercial paper, and I've discussed what a commercial paper is, I think, in the first video in this particular module. I think the video on money markets and capital markets. So if you don't want to trade, you can also participate in commercial papers or commercial notes by these commodities exchanges. So please research the commodities exchanges in your country of origin, or if you're an African in the diaspora in any of the African countries where you have links, and that might be a good way of participating in agriculture funding in a regulated manner. Thank you.